Margin lending. The very phrase sounds like something only hedge fund billionaires use. But here's the shocking truth. Every day, millions of retail investors borrow money from their brokers to buy stocks, and most of them have no idea that they could lose more than their entire account balance. In 2025 alone, over $3 billion in margin accounts were wiped out in a single week during the market correction. One trader with a $50,000 account borrowed $50,000 to buy tech stocks. When the market dropped 25%, his broker issued a margin call. He couldn't cover it. His entire account was liquidated. He walked away with nothing and still owed the broker $12,000. That's the nightmare. But here's the other side. Some of the world's greatest investors, including Warren Buffett, have used margin lending to supercharge their returns. The difference between the nightmare and the dream isn't luck. It's a set of rules. And if you stay until the end of this video, you'll learn exactly those rules. If you stay until the end of this video, you'll learn when margin lending works, when it destroys you, and the specific conditions under which borrowing to invest can be a rational, risk-managed strategy. I'll show you the math, the margin call mechanics, and the single most important rule that separates successful margin users from those who get wiped out. By the time we're done, you'll know whether margin is right for you, and if it is, exactly how to use it without losing your shirt. My name is your name, and today we're going to demystify the most dangerous tool in investing. Let me start with a story that will scare you straight, and then one that will show you the potential upside. In 2021, a 20-year-old college student named Alex discovered margin lending. He had $10,000 in his brokerage account. His broker allowed him to borrow another $10,000. He put it all into a high-flying tech stock. The stock doubled. His $20,000 became $40,000. He felt like a genius. He borrowed more $30,000 against his now $40,000 account. The stock started to fall. It dropped 30%. His account value fell from $70,000 to $49,000. But his loan was still $30,000. His equity dropped to $19, below the maintenance requirement. He got a margin call. He had no cash. The broker sold his shares at the bottom. He walked away with $12,000, having lost $8 of his original money and all his profits. He told me, "I thought I was invincible. I didn't even know what a margin call was." Now let me tell you about David. David was a seasoned investor with a $500,000 portfolio of diversified, low volatility stocks. He borrowed $150,000 on margin, 30% of his portfolio value. He used the cash to buy more of the same diversified ETFs. He set a strict rule: never let his margin loan exceed 20% of his portfolio value. When the market dropped 20% in 2022, his portfolio fell to $400,000, and his margin loan was still $150,000, now 37.5% of his portfolio. He was close to a margin call. But because he had a cash buffer and a diversified portfolio, he added $30,000 of his own cash to bring the loan back to 30% of portfolio value. He rode out the downturn. When the market recovered, his additional leveraged shares multiplied his gains. Over 5 years, his margin strategy added about 2% per year to his returns without ever triggering a liquidation. The difference between Alex and David wasn't the market, it was the rules. So what is margin lending? Margin lending is simply borrowing money from your broker to buy securities. You put up your existing investments as collateral. The broker charges you interest on the loan. In 2026, margin interest rates at major brokers range from about 6% to 12%, depending on the amount borrowed and the broker. Interactive Brokers offers rates as low as 5.8% for large balances, while Etrad and Schwab charge closer to 10 to 12% for smaller accounts. You can typically borrow up to 50% of the value of eligible stocks. So if you have $10,000, you can buy up to $20,000 in stocks, $10,000 of your own money, $10,000 borrowed. The appeal is obvious. Leverage amplifies your gains. If a stock goes up 10%, your return on your own money is 20% minus interest. But if a stock goes down 10%, your loss is also magnified, a 20% loss on your equity. And if the stock drops enough, the broker will issue a margin call. You must deposit more cash or sell securities to bring your equity back above the maintenance requirement. If you can't, the broker will sell your holdings, often at the worst possible time. The math of margin, how leverage amplifies returns and losses. Let me show you the numbers. Assume you have $10 and borrow another $1,000 at 8% annual interest. You buy $20,000 of a stock that goes up 20% in 1 year. Your $20,000 becomes $24,000. You sell, pay back the $10,000 loan plus $800 interest. You have $13,200 left. Your original $10,000 grew to $13,200, a 32% return compared to 20% without leverage. That's the upside. Now, assume the stock drops 20%. Your $20,000 becomes $16,000. You sell, pay back $10,000 plus $800 interest. You have $5,200 left. Your original $10,000 is now $5,200, a 48% loss, compared to a 20% loss without leverage. That's the downside. But here's where it gets dangerous. The broker doesn't wait a year. They monitor your account daily. The maintenance requirement is typically 30% to 40% of the market value of the securities. That means your equity, the value of your securities minus the loan, must be at least 30 to 40% of the security's value. If it drops below that, you get a margin call. Let's use the same example. You have $20,000 in stocks, $10,000 loan, so your equity is $10,000, which is 50% of the portfolio value. The maintenance requirement is 30%. A 30% drop in your portfolio would bring the value to $14,000. Your equity would be $4,000, $14,000, $10,000. 4,000 divided by 14,000 is 28.6%, below the 30% requirement. So before the stock drops 30%, you'd get a margin call. You'd need to deposit cash or sell shares. In a fast-moving crash, you might not have time to react. The broker can liquidate your holdings automatically. The interest rate trap. Why borrowing costs matter. Asterisk. Margin interest is not tax deductible for most investors unless you itemize and the interest is tied to taxable investments. In 2026, with margin rates between 6% and 12%, borrowing to invest in a stock that returns 7% is a losing proposition. You need to earn a return higher than your after-tax cost of margin. For a high earner in the 35% tax bracket, a 10% margin rate costs 6.5% after tax. So you'd need to earn more than 6.5% just to break even. The S&P 500's long-term average is about 10%, so there is a potential spread, but it's thin and it doesn't account for volatility. When margin works, the specific conditions. Asterisk. Let me give you the 4 scenarios where margin lending can be a rational wealth-building tool. Scenario 1. You have a highly diversified, low volatility portfolio. If you borrow against a portfolio of 100 stocks or a broad index ETF like VTI, the risk of a 50% drop is much lower than with individual stocks. The maintenance requirement is also lower. Many brokers require only 25% equity for diversified ETFs. That allows you to borrow more safely. Scenario 2. You have a long time horizon and can weather downturns. If you're borrowing to buy and hold for 10 plus years, short-term volatility is less concerning. But you still need to survive the margin calls. That means having cash reserves outside your brokerage account to meet calls without selling at the bottom. Scenario 3. You are using margin to bridge a short-term cash need without selling investments that would trigger capital gains taxes. For example, you need $50, zeroes in for a down payment but don't want to sell stocks that have appreciated. Borrowing on margin for a few months can be cheaper than selling and paying capital gains tax. This is a common strategy among wealthy investors. Scenario 4. You are a sophisticated investor using margin as part of a risk-managed, low-leverage strategy. The key is low leverage, never borrowing more than 20 to 30% of your portfolio value. At that level, a 50% market crash would still leave you with enough equity to avoid a margin call, assuming you have a diversified portfolio. When margin destroys you, the cautionary tales. Let me walk you through the 3 most common ways margin destroys retail investors. First, over-leverage, borrowing 50% or more of your portfolio value. With 50%, a 30% drop triggers a margin call. In a 2008 style crash, 50% drop, you'd be wiped out completely. Second, concentration, putting all your margin into a single stock or a small number of stocks. Even a great company can have a 30 to 40% drawdown. The margin call will force you to sell at the worst time. Third, no cash buffer, borrowing every dollar you can, then having no outside cash to meet a margin call. When the call comes, you're at the mercy of the broker's auto liquidation algorithm, which sells your most liquid holdings first, often at the worst prices. I've seen this happen dozens of times. A client named Tom had $200,000 in Tesla stock, which he bought on margin with a 40% loan, $80,000 borrowed. Tesla dropped 35% in 3 months. His account value fell from $280 to $182,000. His loan was still $80,000, so his equity was $102,000. The maintenance requirement was 30% of $182,000, $54,600. His equity was above that barely, but the broker increased the maintenance requirement on volatile stocks to 40%. New requirement, $72,800 at, his $102,000 equity was still okay. Then Tesla dropped another 10%. His account fell to $163,800, equity $83,800. New requirement at 40%, $65,520, still okay. But then Tesla had a bad earnings report and dropped 15% overnight. His account fell to $139,230, equity $59,230. The broker had already raised the requirement to 45% due to volatility. New requirement $62,653. His equity was below. He got a margin call at 9 a.m. He had no cash. By 2 p.m., the broker sold half his shares. He lost over $60,000 of his original investment. Tom told me, "I thought I could write it out. I didn't know they could change the maintenance requirement." That's the hidden risk. Brokers can and do increase maintenance requirements during periods of high volatility. They can also change which stocks are eligible for margin. Your margin agreement gives them broad discretion. You have no control. Asterisk the golden rules of margin lending, how to use it without getting destroyed. If you still want to use margin, follow these 7 golden rules. Write them down, screenshot this. Rule 1. Never borrow more than 20% to 25% of your portfolio value. That's the maximum for safety. At 20% leverage, a 50% market crash would leave your equity at about 60% of the original loan, above most maintenance requirements. You'll survive. Rule 2. Use margin only on diversified, low volatility ETFs, not individual stocks. VTI, VO, BND, or a target date fund. Avoid leveraged ETFs, crypto, penny stocks, or anything with implied volatility above 30%. Rule 3. Keep a cash buffer equal to at least 20% of your margin loan in a high-yield savings account outside your brokerage. If you have a $50,000 margin loan, keep $10,000 in cash. When a margin call comes, you can transfer that cash in immediately. Rule 4. Set a stop loss on your margin usage. Decide in advance. If your margin loan exceeds 30% of your portfolio value, you will sell enough assets to bring it back down. Do not wait for the broker to force you. Rule 5. Understand your broker's margin terms. Read a margin agreement. Know the maintenance requirements for different securities. Know the interest rate and whether it's fixed or variable. Ask, can they increase rates? Can they liquidate without notice? The answer is almost always yes. Rule 6. Never use margin to chase speculative stocks, meme stocks, or earnings plays. Margin is for long-term, buy-and-hold investing in high-quality, diversified assets. It is not for trading. Rule 7. Have a plan for a 50% market crash. Run the numbers. If the market drops 50%, will you get a margin call? If yes, your leverage is too high. Reduce it. The tax nuance. Is margin interest deductible? In the U.S., investment interest expense is deductible only up to your net investment income. That includes interest, dividends, and short-term capital gains. You cannot deduct margin interest against ordinary income like wages. For most retail investors, the deduction is limited or zero. Consult a tax professional. In the UK, interest on loans to invest is generally not tax deductible for individuals. In Canada, interest on money borrowed to earn investment income is generally tax deductible, but the rules are complex. In Australia, you can claim a deduction for interest on money borrowed to buy shares that pay dividends, but you cannot claim if the shares don't pay dividends. Know your local rules. Real example, a smart margin strategy in action. Let me give you a real example of a smart margin user. A client named Maria had a $500,000 portfolio of VTI and BND, 80% stocks, 20% bonds. She wanted to increase her exposure to stocks without selling bonds. She borrowed $100,000 on margin, 20% leverage. She used the $100,000 to buy more VTI. Her portfolio became $600,000, $500 original plus $100,000 borrowed. She set a rule, never let her margin loan exceed 25% of her portfolio value. She kept a $30,000 cash buffer in a savings account. In 2022, the market dropped 20%. Her portfolio fell to $480,000. Her loan was still $100,000, so her equity was $380,000, 79% of portfolio value. The maintenance requirement for VTI is 25%, so she was safe. She didn't panic. She didn't get a margin call. Over the next 2 years, the market recovered and then some. By 2026, her portfolio was $700,000. She paid about $6,000 per year in margin interest at 6% for a total of $24,000 over 4 years. Her additional $100,000 invested in VTI grew to about $150,000 gain. Net gain after interest, 26%. She made a 26% return on her $100,000 borrowed capital, even after paying interest. That's the power of responsible margin use. What about leverage ETFs? A common mistake. Many investors confuse margin with leverage ETFs like TQQQ 3x NASDAQ or SSO 2x S&P. Leverage ETFs use derivatives, not margin, to achieve daily multiples of returns. They are rebalanced daily, which means they are not buy and hold vehicles. In a volatile market, they can experience decay, losing value even if the underlying index is flat. Never use margin to buy leveraged ETFs. That's double leverage and a recipe for disaster. Asterisk the brokerage arms race. Who offers the best margin rates? As of May 2026, here are the margin rates at major brokers. Interactive Brokers offers the lowest rates. For balances under $100,000, about 6.5 over $1 million, as low as 5.8%. Fidelity and Schwab charge around 10% to 12% for small accounts, but they can negotiate for larger accounts. Robinhood Gold offers margin at about 8% for the first $1,000, then 11.5% not competitive. E-Trade is similar. If you plan to use margin regularly, open an account at Interactive Brokers. The lower rates make a significant difference. The bottom line, should you use margin? For 95% of retail investors, the answer is no. The risks outweigh the benefits. The psychological toll of watching your leverage magnify losses often leads to bad decisions. The interest costs eat into returns, and the complexity of margin calls and maintenance requirements is too high for most. But for the 5% who are disciplined, diversified, and have a long time horizon, a small amount of margin, 10–20% of portfolio value, can add 1 to 2% to annual returns over a full market cycle. The key is to treat margin as a tool, not a drug. Use it sparingly, with strict rules, and always keep a cash buffer. Here is your action plan for today. First, if you currently have a margin account, check your current loan-to-value ratio. If it's above 30%, reduce it by selling shares or adding cash. Do it today. Second, if you are considering margin, write down your rules. What is your maximum leverage? What is your cash buffer? At what portfolio drop will you deleverage? Keep this document where you can see it. Third, calculate your after-tax cost of margin. Use your margin call tax rate. If the after-tax cost is above 6 to 7%, margin is unlikely to be profitable over the long term. Fourth, never ever use margin to buy individual stocks, options, crypto, or leveraged ETFs. Use it only for broad market index funds. Fifth, open a margin account only at a broker with low interest rates and transparent terms. Interactive Brokers is the industry leader. Sixth, comment below. My margin rule is, share one rule you will follow. I'll reply to the first 50 comments. If this video saved you from a catastrophic margin call, hit the like button. It helps others see the danger. Subscribe and turn on notifications. In the next video, I'm going to reveal the pay yourself first method, why most budgets fail, and the one that never does. More lending is a powerful tool, but like a chainsaw, it can build a house or cut off your arm. The difference is respect for the tool. Use it wisely. I'll see you in the next video.